Welcome to the Impact Diaries. This is a conversation powered by Liaison Group. Here we talk about the critical matters affecting the industry. And today we are focusing on the pension sector here in Kenya. We'll be discussing the outlook, from the year 2025 and beyond. And because we are talking about retirement, we can't do this one without the regulator. So I'm joined by Julie, who is representing the regulator. Julie, you can just tell us a brief intro about yourself and the regulator.
Thank you, Keli. My name is Julie Oloo. I'm a Senior Supervision Officer at the Retirement Benefits Authority, and I'm pleased to be here.
Most welcome, Julie. And of course, myself, I'm Keli. I'm the General Manager in charge of the pension business here at Liaison Group. Welcome, and let's have this conversation.
I would say that the enhanced NSSF contribution rates is much welcome because this is not a new occurrence. Whenever we share with members and we tell them that once upon a time there used to be contribution rates at 80 shillings, and I think what many people have known NSSF contributions is 400 shillings, which is 200 by the employer and 200 by the employee. So that already just shows us that this progressive contribution rates that are guided by the NSSF Act of 2013 in the Schedule 3 is not totally new. So first of all, we welcome the increased rates because this means for many Kenyans that they're going to retire with dignity, where we see inflation, high cost of living. So in another 10, 15, 20 years, it means there's more impact for the retirees. So this is something from a regulatory perspective that is very welcome. It's something that we have been driving for a long time for employers to consider increasing contributions to pension schemes, just the same way salaries are increased either on an annual basis or after every 3 years or based on the policy of the employer. So this is very welcome.
Yeah, thank you. That's a good question. By the end of the day, the goal is to increase savings as a country. But then sometimes how the deduction comes in can actually lead to that change of attitude from the people who are being deducted. There's actually a big discussion whether is it a tax or is it a saving. I think there are very many schools of thought. Some people will tell you if you are deducted and you don't have control over that, it's essentially a tax. But then there's also another balanced definition where somebody says if you are deducted and it can come back to you, then it's a saving. So I would tend to think NSSF really comes in on the realms of savings. By the end of the day, NSSF exists to provide, comfort in retirement. And as you've talked about the journey coming from 80 shillings to 400 shillings, those ones were not even sufficient. So I think now we go to the increased deductions. There could be a pain at the moment, but in the end, they contribute to the savings pot which everybody needs.
That clarification, very true, is important. We as a country and in the pension sector, we want to embrace competition, healthy competition. So when we look at the drive that NSSF had envisioned or what it was envisioned as sufficient pension savings at 12%, which is shared between the employer and the employee at 6.6, then for an average of the Kenyan employers, that was almost the contribution rate that was being sent to private schemes or what we call occupational schemes. So in the development of the NSSF Act and the pool for that healthy competition, it was felt that a portion should still be shared between the NSSF and the private schemes. That is why we came up with the Tier 1 and Tier 2 to be able to distinguish what can the employers continue saving for their employees in the private schemes, and then what also can be segregated and invested at NSSF. So that is where we now see Tier 1, which is the smaller portion of the contribution, which takes into account the lower earnings limit. So that is what primarily institutes tier 1 contributions. And then what would now be segregated and by the choice of the employer want to move it or retain it in their private scheme that they had prior, then now that forms the tier 2 contribution, which is a difference between the upper earnings limit less the lower earnings limit. I believe for ease of this discussion, maybe we can use figures. So we can see that in the first year of implementation, because we can't just get up and implement 6% on an employee's payslip, but we could progressively, and that is why it was called progressive contribution rates. When we computed the tier 1, which is the lower earnings limit of 7,000, we were getting about 420 shillings. So that would entirely compass tier 1 employee contribution. So of course the employer would match that. And then using now the upper limit, which was upper earnings limit, which was 36,000. So of course the competition there is you get the differential and then apply 6% of that. So the tier 2 contributions were about, I think, 1,740. So then now for employers who are already contracted out that and were participating in reference schemes, that tier 2 is what they could transfer and manage in their private schemes. So incrementally now in 2025, what we are going to see this February is the progressive rate now increasing. So the rate remains at 6%, but it's the lower earnings limit that increases from 7,000 now to 8,000. So when we compute that, we now see the 420 comes to 480 shillings. Then for the tier 2, the upper earnings limit moves from 36,000 to 72,000. So huge incremental difference there. And if you compute the differential now, again, because when we see 72,000 as an earning or pensionable earnings is quite on the higher side, and we'll find majority of Kenyans earning below that. So for any employee who's earning below that, then they will use their actual earnings less the lower earnings limit. But those employees earning above that, then they will use a maximum of 72,000. And if you take the differential between that and the lower earnings limit, they'll be applying 6% to about 64,000, which then would mean that tier 2 contributions move to about 3,000 and about thereabouts. Yes.
Private pension sector, actually, they came in to play a big role, which is accumulating pension savings in a way that was more effective and was more accessible to members. So as the NSSF rates actually increase, in the meantime, they're eating into that space. So the pension funds can actually see reduced contributions in the meantime. But then again, as you put out, there's actually time for healthy competition. So the private pensions are not lying, and waiting to die. Essentially, they are now utilizing that opportunity to opt out because tier 2 can either go to NSSF or come to the private pensions. So now they are moving out existing employers to really, really opt out and ensure they get a piece of the pie. So, and in this sense, once NSSF grows, it's the whole pension industry which grows. So everybody grows. But in the meantime, now it's up to the private pension funds. And we're actually doing it to ensure that we remain in the market.
It means quite a lot also to private pension schemes because as we were registering or contracting out employers, we saw a tremendous growth in umbrella schemes because we know by nature umbrella schemes take in employers who essentially did not want to establish their own occupational schemes. And these employers would purely participate in NSSF and they were okay with the contribution rates there. But as we continued having discussions about the NSSF Act, and it heightened the awareness of employers that they could do better in terms of retaining their employees, rewarding their employees. So quite a number of even the employers who were, were under the table, probably were not registered by NSSF, came out and asked, what does this mean if we participate? Does it mean that we would be late? Is there a late registration with NSSF, and can we still register and contract out? And with the clarifications, we actually saw an upsurge of employers coming now to join the private pension schemes, especially the umbrella schemes. As at very latest, Friday last week, which was 14th of February, we had contracted out over 3,000 employers, just about, I think, 3,100 thereabout in total from the beginning of the contracting out period to that date. With regard now, if you want to see the comparison between employers and schemes and that growth, because we have registered about also 370 reference schemes. So then you can see that if we were to count that every reference scheme is for a particular occupation, for example, let me use RBA. RBA, we have a scheme for staff members. So it is a registered reference scheme, but it only limits membership to the members of the RBA retirement benefit scheme. But now we can see that if we have only 370 reference schemes, but 3,000 employers, it means that the other over and above employers are participating in umbrella schemes. Yeah.
How we actually get for you to understand the return, you have to understand the investments, how they are done. And then to do the investment for pension funds, it's a very highly regulated space. We start by having an investment policy statement. This basically looks at the risk profiles, of the scheme membership, because different schemes will have different risk profiles. From now, looking at the risk profile, essentially, retirement savings will seek to achieve only three objectives. People want their money to be safe. They want the funds to be liquid for them to get that money when they retire, and then they want that money to grow. So now we capture that in the investment policy statement, which is actually filed with the regulator, and this is actually what determines what we do with the funds. But now, by the end of the day, to deliver the return, now we have to invest the funds. Then the investment is done in a way, first of all, we have to diversify across different asset classes, to get exposure to different sectors, different geographies. And diversification is actually the basic of any investment. But actually it came to bite. Like recently, we put most of our money, due to long-term nature, we'll actually put most of our money in government bonds. And recently when government bonds took a hit because of the increasing interest rates, you saw the whole industry, kind of become jittery. So we have to really, really keep on diversifying. By the end of the day, we do research, and ensure we look at the available investment opportunities. We put the money in the higher performing assets. But again, you have to balance risk and return. You can't, even if when the return is very attractive, you also ensure we look at the risk of the members. So we keep researching into the available emerging opportunities. Like now, the government is actually looking for a lot of funds to pro infrastructure. So we are really looking at the opportunities which are available there. But of course, ensuring that we get our money back.
With every incremental increase, be it financially or be it through members, the regulator is always alert, and we do change our supervisory stand. I know we have been running the risk-based supervisory approach for quite a few years now. But when this amendment came and it is being implemented, we had to relook into the administration part of it first, ensuring that whenever these administrators, because part of the regulations is what guides the authority, we work within the law. So contracting out regulations mandated that there has to be some specifications on how, when this risk is transferred from NSSF to a private scheme, are they going to uphold those protected rights as envisioned? So we ensured that every administrator had updated their system, or any administrator who wished to manage these funds, which of course everybody was on board to administer these tier 2 contributions. So we had to inspect, check their systems for their robustness if they had upgraded, because we knew first and foremost member statements were going to change, so that we could clearly see the normal contributions against tier 2 contributions. Then for fund managers, their mandate increased. Most of them now were used to just the regular contributions. But I may weigh in here and say that majority of the employers who already were participating and making contributions to the tune of cumulatively, say 30%, where maybe it is on a scale of 10 and 20 or 7.5 and 15, most of them amended. They did not want the excessive addition in terms of contribution towards NSSF. So they just amended their trust deed and rules to still factor in within their normal contribution rates to have the 6% or the tier 1 and tier 2 within that mandate. So you'd find that fund managers continued managing the same magnitude of contributions that they were receiving on a monthly basis. However, for schemes, like I said, the umbrella schemes, where of course every new employer who joins increases the monthly contribution that the fund manager is going to receive and manage. So we really had a lot of engagements with fund managers, especially on the contributions from NSSF tier 2, the precautions they could take, knowing that these were contributions that had to stay in the scheme all the way up to a member's retirement, but of course with portability and expectations of how they will do the valuation of those assets. So the regulator, as from the regulatory perspective, we also amended our risk toolkit to take into consideration for that, so that schemes that now are reference schemes have extra elements that we now look at over and above the normal scheme supervision.
We actually understand the plight of our contributors, and actually their pay slips and a lot of pressure. And it's not only pay slips, even after they get their net income, actually there's a lot of increased cost of living, things like healthcare. They are really, really up. And this is every time you're in a group or something, contributing something for somebody who is disadvantaged. So yeah, we have to start there by appreciating where they stand. And now for us, we what we can do at the moment just to encourage them, to prioritize retirement savings, because all these needs they have today will still come back later. And actually, it is not from those retirement savings that we'll be able to cater for the needs that will come later. So we really, really tell them to prioritize retirement savings, ensure there's something for that. But now, actually, how are we doing it? We are doing this through investing a lot in financial literacy. As you said, with NSSF contributions, a lot of even small employers came to the pension, basket. So we are seeing a lot of contributors actually. So we are investing more on member education, because by the end of the day, financial literacy is all around. It's not pension alone. So as people learn how to manage their finances, coming from circle deductions, pension, what do you save, what do you invest, even short-term investment like money market funds, we are having holistic conversations. Because now once people can manage their pot, because for them it's just one pot, and pension savings, we want it to be a portion of that pot. So we want people to have better visibility actually of what they are doing. And then actually from that, now we've seen people now realize actually, yeah, they're still in a fixed bar, they can still put something aside. But it's a conversation that is taking a lot of people. Then also the government policy is also coping a bit, because as much as there is those pension, not a lot of deductions on the pay slip, there's also some reliefs which came actually with the tax laws amendment on the getting tax relief on pension contributions. And also when people leave, actually people always say that when I've saved for all that long, why should I be taxed in the end? So we saw the regulator actually work with Treasury to ease the tax burden. We hope now those benefits can actually help people to put in more money.
this has actually been the desire of the regulator, and we have gone ahead and purely, if we look at the strategic plan for the authority, the one just we concluded, the informal sector was at the heart of it, because we realized that when somebody retires, it doesn't matter whether you are formally employed or informally employed. Secondly, retirement is not what is the ideal. I could also be employed, but retirement either comes early through ill health or, other means, maybe redundancy at your workplace. And everybody had to be put into the picture so that then we have a healthy population, because if you're only taking care of a very small section of the population, then we are not doing much. So a lot of strategies that we employed now was to look at this sector, coming up with literacy specifically, not just general, because the way you speak to somebody in the Juakali industry is not how you'll speak to somebody who is formally employed. And it's not just the language alone, it's also sometimes their time. You've curated a program and you want to hold them from probably 9 in the morning to 4 p.m. discussing different things. You've robbed them of their earnings of the day. So we had to come up with innovative ways to reach out to them, going down to the level, going down to the matatu stage, boda boda stage, so that they could listen as they work. Going down to the markets to talk to the sellers, the vendors as they do their business, making them shorter and sweeter, having a 1-hour conversation so that they could just get the major points. And there was a lot of interest actually that came from that, and also involving them in the policy formulation. They actually came back and gave us feedback that we did not know that one day we could be called to, a meeting to contribute on our ideas on how to make a product for us. So we wanted that buy-in from them, because when they feel that they have created it, then they can be able to be part of it. So we are we're not saying that we are there yet, but we're still improving on the approach that we do for the informal sector. We are also registering and encouraging the industry players to come and register products for the informal sector. We have what we call sandbox approach, where from the industry players, if you have an idea that you'd want to try out of the regulation, then we'll listen to your proposal, allow you to work outside the regulations just for our, a small unregulated population. And if your proposals or your product works, then we can roll it out for the market with the right regulations, because we realize that the informal sector cannot fit in these regulations as they are, where you tell an employee that, or a Juakali person, that you have to remit by the 10th of the following month, or you have to remit every day, or, and there are consequences for non-remittance. So we believe that with the industry players, we are going to come up with better regulations for them and products.
Yeah, it's a good question actually, because the informal sector remains our biggest growth area. On the formal sector, we've more or less is more or less saturated. So we are really having products which have to speak to the informal sector. But then again, before we do anything, we have to look at the needs, of the people in the informal sector. So most of them, because of the nature of their work, first of all, retirement doesn't seem like a viable conversation to them. As somebody who knows they will try at 60. For them, they know they work, they are skilled laborers, they can work for a long period of time. So they are looking at products which are flexible, they can bring their contribution as and when they want. Again, they're also looking at flexibility even in accessing, the funds. Sometimes somebody could be in a fix and they want to access. So essentially, they want bundled products whereby it balances the needs of today and the needs of, later. At the end of the day, they also want ease of access. We can't tell them fill a form, so you have to to plug into their technology, USSD codes, telling them just dial this number and get your money, dial this number and see your contributions. Also, we have to invest in our systems. That's why when somebody contributes, we have to build trust, as opposed to somebody who's deducted at payroll and they know they can wait. For them, somebody wants you to contribute your money, you want to see it, the return. So we've had to invest a lot in visibility. First of all, for them to look at to see actually what they're actually doing and track their progress. And then also this takes a lot of collaboration. We have to, first of all, because they also have a lot of affinity groups, you have to go through them, go through them to access the people, talk to them, and also collaborating with other players. Sometimes you can't really do this one alone. As an administrator, you have to work with a fund manager. You have to have like partnerships, which will help you target the market. Then also now partnering with the regulator, like using the sandbox to test out ideas in a safe environment, whereby it is not really fully regulated, but then you have the eyes of the regulator. So it is a conversation that is taking everybody. But again, the gains are still very, 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 very small. There's still a lot that needs to be done, but we are attacking it a day at a time.
Unremitted contributions, yes, has been a thorn in the flesh because every employer, upon registration of a scheme or joining an umbrella scheme, has the best interest of its employees at heart. So when we then, because we receive the reports from administrators like yourselves every quarter, and we get to observe what happens. This used to be a diligent and a compliant employer. And then you see contributions have not been remitted for 3 months or maybe 1 month. We have then now to have the discussions, engagement with the employer and find out what is the cause of the unremitted contributions. So primarily, we've been holding a lot of discussions with sponsors and offering advice based on what the challenge is. So most employers, you'd find that maybe they were a bit too ambitious with the contribution return, so they're not able to afford the total contribution. So when we discover that that is the challenge, then we tell them that already what is in the regulations, you can amend your contribution rates. Of course, you cannot amend retrospectively, but as at when you give sufficient notice as guided by the trusted and rules, you can inform your members and make the necessary changes. So, but for the section that already was unremitted, then we give the employer up to, the law gives them up to 6 years where they can develop a remedial action plan to try and remedy those contributions or settle them. But of course, if the law says 6 years, it doesn't mean that if your unremitted contributions was for 1 month, you want to take all the entire 6 years to remit that contribution. Then we try and agree on a suitable date. But ideally, this is something that the sponsor does and then they submit to the authority so that we can approve the remedial plan. And we've seen those working very successfully. However, there are also those unremitted contributions that also arise not because the employer deducted and did not remit. Probably there was a collective bargaining agreement that increased pensionable pay and it backdated it. So automatically it means that if 3 years ago this is what I should earn and money will be put into it, it means that pension again has increased by that amount. So you find that most times this pension contribution is not factored in and we keep carrying this burden and having discussions. So those are the ones where we are now seeing anytime maybe there's such agreements that are discussed, we remind the parties involved to ensure that if you touch on any benefit for the employer that would mean would have a direct impact on pension, please also find the contributions that would match that. At the last resort, if the sponsor is unable to meet these unremitted contributions, then we normally advise for voluntary dissolution of the scheme, cessation of contributions. But the member still, what as RBA we uphold is that a member should not lose. So if there's a closure of a scheme for future contributions, then the sponsor, now in the same remedial plan, will find means of ensuring that all the contributions are remitted. The member still doesn't lose out because interest which should have been earned if the money was in the scheme, then now is transferred to the sponsor to remit into the scheme. And we've seen those also successfully being adopted. Of course, now there are others. We still agree that our regulations or the Act require a lot of improvement to give provision of recovery of unremitted contributions. So as lately, you can see that we had brought on board KRA to help with the recovery of unremitted contributions, and we adjusted part of the KRA Act to give them the powers now. So the powers were there, but the modalities of how they were going to carry that out. So we keep on improving our regulations. So, and we also urge the sponsors when they detect that when they do their forecasts and they feel that this is going to be a toll burden on them, we always encourage them that they can reach out to the regulator to offer advisory or assistance before it actually crystallizes, so that we are not perceived as the regulator with a stick, but the regulator with a carrot, and we're here to assist.
Coming on that unremitted contributions, most of it is actually in government institutions. As a regulator, do you also engage Treasury maybe to see what can be done? Or do you actively participate in helping to get the contributions?
Very much, because one of our mandates is to advise the CS, National Treasury, not only on other policy matters, but on matters that affect members' contributions, especially now in the public sector. And if we look at the figures in terms of the unremitted contributions, we'll find that above 90% of the unremitted contributions then is part of the public sector. So we do actively engage with National Treasury to tell them, maybe these are the strategies we can take, because they're ultimately, just the same way we speak to private sponsors, National Treasury is also a sponsor when they wear a different hat. So we do offer advisory. Task force are formed where to look into what can be done, because if the matter is very chronic, you sometimes really require to roll up your sleeves and get things done. Some of the outcomes of our engagement with National Treasury, we have seen debt swaps where, we get exchange of, we might not get financial contributions, but then we're able to see transfer of assets from the sponsor, with being National Treasury or the various institutions, to pension schemes, so that they're able now to manage. So when it now gets to the pension scheme, and again, it conflicts with our Table G regulations in terms of maybe if it is property, it is exceeded the upper limit. We say that we'd rather have it, and then we shall advise the trustees on how to remedy the situation. So we've seen a lot of success outcomes of that. I think that's an example I can use, although we still have a lot to do.
Yeah, and unremitted contributions, acts as a big discouragement, for members. By the end of the day, they can't even see what has been deducted yet. It's become. But then, is an education issue. First of all, is showing actually empathy to them, but telling them actually we actually understand, engaging the employers together with them. And also you realize even there are those like vulnerable contributions sometimes. When they come, they're actually separate from the employer. So even tell the employer those ones can actually be coming because they are part of the salary, you know. And also now to the people especially in the formal sector, just telling them whatever could be affecting one employer doesn't actually affect you directly. So it's just basically accounting for ensuring we keep proper records and we don't mix up those conversations. Yeah, but again, it remains a big discouragement. We're just working with government to ensure that the funds come and everybody can see their money. Because once they see it, that's where now you can have the conversation on bringing more into the system. The incremental contributions actually in February seems to be taking center stage. But actually, when you look at regionally, because we participate in, or we are basically patient across the region, you realize like Uganda, they are doing like 20, actually Uganda are doing 15%, Tanzania are doing 20% actually. And then Rwanda actually are on a progressive rate like us. Actually now they got to 12% and moving on to get to 20% in the next 5 years. So we are not alone. I think we are at 12%. There's still an opportunity to really, especially for us private sector players, to push for more pension savings. So we are not alone in this journey. But now coming to what we expect in 2025, as I said, basically on the overall pool of pension assets is going to increase, with the increased NSSF contributions. So for that, we expect to see a lot of competition, especially in the private pension players trying to get a piece of that, and we are prepared with products and innovation to get into that. So we expect to see a lot of innovations, targeted to the mass market, to the bottom of the pyramid. Essentially, our own private pension plans and umbrellas, as you're saying, we expect to see a lot of growth in that. And then again, even on the regulator, we expect to see regulator, upping, their regulatory ante, basically checking and ensuring those NSF contributions, the preserved rights, are they really accounted for separately? But now, by the end of the day, everyone wants a return. First of all, the markets have been rather depressed for the last 2 years or so. But then we saw full recovery in 2024. The average return for most of the sector is like 28%. But that was just coming from a one-off recovery. I think the annualized return for 3 years or more is like 10%. But then we expect that one to be maintained, in the short term. We've also seen CBK through the Monetary Policy Committee push for lower interest rates to allow for flow of credit in the private sector. So from that, we expect to see, recovery in the economy as a whole. And because we participate in the economy, once the economy, does well, then we will expect the pension funds to do well. So our outlook in 2025 is basically is positive, hoping to do better than the previous years combined. Yeah. But then again, we have to, should there be any challenges, remain ready and alive to basically tackle them as we go.
Kenya has a lot that's in store for the pension industry. It's bubbling with people who are now, their financial literacy is increasing. They also demand of employers and trustees has really grown tremendously. I think with the introduction of the trustee development program and the good governance guidelines, and us requiring that this information is cascaded to the members. So we're seeing a population that is eager to plan for their retirement, a population that wants transparency, a population that also is eager for the best return. So we urge trustees that things that are within your control, please adopt, like management of your expenses. And we have aided that with the introduction of the remuneration guidelines to at least manage scheme expenses. So that is just being very responsive to the member. So as a regulator, we are looking at the member's ultimate objective, ensuring that we safeguard and not just put in a box and give them exactly what they contributed and put in the pot, but come up with regulations that is going to expand their horizons for the members. So we know that there are quite a lot of people who are still outside the coverage. So we have a dream to ensure that every member or every employee is covered, and we have set a target of slightly above 30% in terms of coverage, both informal and informal sector. So we know we can do better than that, but that is just a target for the short term. So again, in the spirit of collaboration with all our industry players, we are always ready to assist, be on hand to offer that assurance to the members that you're targeting. And also try and bring out the idea that retirement is not just some place that things will take care of themselves. You have to plan for them now and have also a desirable replacement ratio, which is anything between 40 to 60% good. So don't just have a contribution and say I was participating in a pension plan, but what is your desired outcome as an individual? And then where can RB as a regulator assist from the industry players, the sponsors, to the members?
By the end of the day, you are saving for your own private need. So first of all, you have to see your funds grow. And once now those funds grow, actually, they'll come to cater for your needs later. But then again, this actually has a ripple effect on the economy because all these funds, actually, as I said, we invest here. We have some bit of investment offshore, but usually very negligible. So it helps even the government. The biggest beneficiary is the government. Most of the funds, like 60-70% go to the government, so the government gets access to credit, which have to be prudent, invested in projects which come again to help the people. So there's a ripple effect. This is like a circle between us and also we put some of the money in the local banks. So the economy generally gains from those savings. But by the end of the day, nobody invests for the economy. You're investing for yourself. So it has to, first of all, make sense to you as a person. And I think as an industry, what we are doing towards that to increase the national savings, we have to have products which are responsive, to the needs of the people. And even now, as you go, mainly there's a lot of, even when you read the RBA strategic plan, what will get us to 30% is actually made informal, and the people who are not currently in the space. So to get those people, the products that we are using are products which have, I said, is a balance between now and future. So we are seeing like personal pension products, which are a bit flexible. And you can, like now, own my fund, you can actually get some part of the money as you go, just basically having a balance of now and the future. But then also we're having bundled products. People don't want a lot of deductions. I don't want to be deducted this one for that. So like now in the umbrella schemes, you can have the same deduction, but then you have decided what goes to the pension kitty, what goes to the, the post-term and medical cover. People are looking for bundled products, which are very easy to, but then all of that needs to be done in a way that is very transparent. Because now if we are not clear to our members, that's where the confusion starts. Yeah, so essentially the goal is to push, the savings, but then we have to push it in a way that delivers benefits to the members. Because if now we deliver benefit, then that is what makes it sustainable.